I'll start with you, David. Pretty much on the economic assumptions in this report, which seem relatively constructive, but not without challenge.
Well, yes, absolutely. I mean, we do this every year. This is the 29th year we've been doing it. And so we have to look back over the last year and see, well, what have we learned? And what we've learned is, first of all, the U.S. economy in particular, but the global economy has proven to be pretty resilient. And we're seeing effects of AI, particularly in the U.S. Economy. We're seeing better labor force growth than we thought we'd see. And so we were able to actually mark up our forecast for the long run for the U.S. It used to be 1.8%, now it's 2.0%. That's positive. And then the other positive is less inflation. Because it turns out inflation really was a cyclical event associated with the pandemic, the response to the pandemic in Ukraine. And that has really faded here. And so we're able to mark down our CPI long-term inflation forecast from 2.5 to 2.4. So now we're looking at 2.0% growth, 2.4% inflation out as an average over the next 10 to 15 years. And that is a very strong foundation for asset classes.
So what does that mean, Monica, for your clients? I mean, are they going to share in that optimism? It seems like a lot of people are still kind of skittish.
I think that's absolutely right. I mean, people are very focused on the higher points, whether it's equity markets, higher rates, higher volatility. But I think what they'll look through is an opportunity when they're investing on a stronger foundation. So the fundamentals, we call it healthier fundamentals. The fundamentals, whether it's macro, as David just pointed out, or on the corporate side, right? We're seeing stronger earnings per share growth. When you think about earnings power, you're seeing margin improvements. Like, this is an opportunity. That tech adoption that David was talking about, that's not only going to help in terms of revenue growth, but also importantly, improve margins. It's going to help take away that no joy work that everybody has and improve those margins.
Yeah, a lot of no joy work day in and day out. What David was painting was kind of like a continuation of the U.S. exceptionalism thesis. Would that be fair to say that continues, but perhaps it's a little bit less exceptional going forward than it has been?
It's a really good point. I mean, when we say U.S. equity dominance, when you think about AI or tech adoption, they've really been concentrated on a few companies, right? The Mag 7. We see a broadening out of the 493 companies out in the S&P 500. And we see that tech adoption both helping, whether it's manifesting itself in terms of capital spending and in terms of also margin improvements. So that broadening out will be really important and help the U.S. maintain that market capitalization for the rest of the world.
What does that mean for a balanced portfolio? Is the 60-40 portfolio alive or dead, David?
Well, it's alive, but the challenge is, I mean, this year we marked down our forecast for this because markets have been so successful. You know, you often read the bumper sticker at the bottom of a report is, you know, past performance is not indicative of future returns. Actually, it is. Past great performance indicates more difficult returns going forward. But last year we were at 7.0% for a global equity U.S. bond portfolio, 60-40. Now we're gone from 7 to 6.4, so it's less. But we do see plenty of opportunities in alternatives, in international equities, and also just within the way we manage equities. Because one of the things, you know, when you're talking about challenges, we do have higher valuations, but we've also got a big concentration issue.
Well, it's interesting, too, because there was a note out from one of your competitors kind of talking about this idea that annualized returns for the S&P could enter sort of a new era of single-digit moves instead of the double-digit moves we've enjoyed over this last decade. And a big part of that, and I'm actually going to pose this question to Monica, because a big part of that thesis was this idea is not necessarily that money's coming out of the market overall. It's just not going to be going into equities and, to David's point, into alternatives and into fixed income as well.
Yeah, I think that's, you know, when we look at this report is focused on the long term. And so absolutely, at these higher points, we're going to see some, and this is in our research, we're going to see some multiple compression, right, in traditional equities. But it doesn't mean that investors aren't going to be investing on that healthier foundation that we pointed out, whether it's macro or corporate. And the balance of that is also, this is not just about stocks and bonds. We absolutely believe that this is an opportunity for investors to allocate to alternatives. I mean, this is a generational opportunity in real estate. All we've been reading about real estate is asset markdowns and price declines. We're going to change the dialogue and move that to investing in things like non-core real estate, where the modernization of real estate, the innovation, think data centers, cell towers, that's a significant opportunity. Look at the capital spending going on with governments and private capital expenditures on infrastructure. Really important areas for hedge against inflation, strong cash flow yields. That's going to be opportunities for investors.
But sort of bring that back to us, David, because when we talk about that spending, and even what you said there with government spending on infrastructure, positive. There's a lot of government spending on other things that could be a negative. And when you talk about the long-term nature of this report, looking out 10 years or more, at some point you've got to be factoring in the budget and balance sheets of the United States government.
Well, yes, and I mean, and that's really why we so believe in diversified portfolios, and this is why we think this is really a call to action. Because even though our macro forecast doesn't change that much, markets have moved a lot. They've become more concentrated. They've become more expensive for U.S. equities. And while we believe in the U.S. equity story, it's not without risk. And one of those risks is the budget. I mean, if both, our political system seems to be generating this huge upward trajectory on our debt, unlike, for example, Europe, where they've got slower growth. But they're also more careful about their budgets. And if this sometime comes back to bite us, you'd want to have some international exposure. And a lot of people have been sort of either directly or deliberately or passively have been shifting away from international exposure because as their U.S. portfolio goes up, if they didn't rebalance back to international, and that's been pretty hard, they're finding they've got a smaller and smaller share of their wealth outside of large cap U.S. equities. And that's a risk.
You mentioned something about inflation, how you marked down your forecast for inflation. So there'll be slower inflation, but certainly not a return to minimal inflation, right? The post-financial crisis, pre-COVID levels of inflation. Those days are long gone.
We think so. We don't think this is a very inflationary economy, but what we do think is we've got more active fiscal policy, more active monetary policy, and particularly in the United States, if we've, any hint of weakness and let's just do some more stimulus. I mean, this is the most stimulated economy, but that does lead to somewhat higher inflation. And even if it didn't lead to higher inflation, the amount of money the government is borrowing will probably put a floor onto long-term interest rates. So I think inflation won't come down to where it was pre-pandemic, but particularly long-term interest rates are unlikely to come down to where they were pre-pandemic.
And of course, Monica, you had to do this not knowing who's going to be in the White House in 2025. What's the most fundamental basic assumption you built in no matter who wins the White House?
Well, this is very focused, like I said, in the next 10 to 15 years. A lot of us are focused on the near term. And so when we're looking out, and David should touch on the election point, but when we're looking out and we're advising investors, we're talking to them about the cash on the sidelines, for example.
The $6.5 trillion in money market funds.
The $6.5 trillion in money market funds. And when you think about that opportunity cost, because what we're talking to them about is their long-term goals, right? There's real risk to keeping in cash to meet those long-term goals. And we actually did this analysis where we said, if you had $100 and you forecasted out the next 10 years, that $100 only goes to $136 if you're just in cash. That $100 goes to $180 over the next 10 years if you're in a 40-60, 60-40, and then with an alternatives, it's go greater than that. So we think that that's actually the biggest risk is not meeting portfolios to meet your long-term goals.
Since you kicked the election question back to you, David, you get the short straw here. And I do want to specifically hone in on this idea of protectionism. We talk about the health of U.S. capital markets, but a big part of that health has been it's a relatively open market and has been for centuries. What happens if this protectionist bent that we've seen from both parties to a certain extent intensifies? Does that change your outlook?
It does in the short run, absolutely. I mean, it's tariffs. Any economist you have here will tell you that tariffs are a stupid idea, because you raise tariffs. It's almost a stagflation elixir. You can actually both achieve higher inflation and slow the global economy at the same time. But that's why they don't persist for very long, and that's really why it's not something I want people to really focus on in long-term capital market assumptions. Because if we did have a sudden rise in protectionism from where we are right now, it could cause some damage to the economy. Then everybody backs off. And maybe there are trade agreements, and then the economy bounces back. And it's that bounce back in the economy and markets that I think is so important. I mean, even after COVID, I mean, the pandemic, what more seismic event could you have? And yet, if you'd gone to sleep just before the pandemic with your long-term portfolio, did nothing, and then woke up a year or two later, you're substantially richer for not trying to time it. So we tend to fade the idea of trying to time a portfolio around elections. Take careful look at what's expensive, what's cheap. Think about these long-term trends and base your portfolio on that rather than trying to A, guess the election and B, guess how the election is going to affect your portfolio, because that second part is really difficult.